Welcome back to yet another valuation for a couple of relatively large gold miners based on their Q2 reports. And remember, this is a fundamental valuation which might vary from the current market price, which is affected by day-to-day and even week-to-week fluctuations. As usual, in our model, we look at discounted per share value after all-in sustaining costs, long-term debts, and taxes. And in our model, we only look at proven and probable reserve as well as half of measured and indicated resources, without taking into account any of the inferred resources, never mind any of further exploration success. So to the extent that the market price might actually correctly value some of the future potential success, the fundamental valuation presented here might be different. But as you see, we like to lean conservative here by looking at relatively more established reserves in the ground. And of course, the data that we plug into the valuation model includes the prices of gold, silver, and copper, the amount of reserves and resources in the ground, the costs of extracting those reserves. We'll look at all-in sustaining costs. We'll look at long-term debts and taxes. Of course, we'll look at per share value with a discount rate of 5%. And we have a bit of a secret sauce on insider shares, as larger percentage held by insiders helps to align the incentives of the management with those of the regular shareholders. So starting with the gold price scenarios, as usual, we're going to look at three scenarios with a balanced valuation plugging in the gold price of $1,900, conservative valuation plugs in the gold price of $1,600, and the optimistic valuation plugs in the gold price of $2,200. As you see, even in our optimistic valuation, we are far from outlandishly optimistic, and personally, I do think that gold price has a good chance of going far beyond 2,200, perhaps over the next couple of years, as sentiment improves. Next, as for resources and reserves in the ground, looking at gold, both have somewhat comparable resources. AngloGold Ashanti doesn't have any silver, but it has much more copper. So both of these miners are somewhat of a comparable size, including market caps of numbers of billions of dollars. As for their costs, all-in sustaining costs and debts, we see that AngloGold Ashanti is a much more leverage play to what happens to gold price, as all-in sustaining costs is higher, nearly $1,430 per ounce of gold, and long-term debts are just above $2 billion. Whereas for Gold Fields, all-in sustaining costs are at $1,320, with long-term debts at $832. For tax, I just assume a flat tax rate of 25% for all of these miners to simplify this process a little, to speed up my calculations. Looking at cash, it is important to look at cash, as we don't want to go into companies that follow the track of Gold Corp. So we can have a look at cash here, but it doesn't plug into the valuation model. Both have several hundreds of millions of dollars in cash, above 700 for AngloGold Ashanti and above 600 for Gold Fields. Moving on to shares outstanding and discounting, AngloGold Ashanti has over 419 million shares outstanding, whereas Gold Fields has over 893 million shares outstanding. Unfortunately, in either of those cases, insiders hold 0% of those shares outstanding. That's according to Yahoo Finance. And looking at proven and probable reserves as opposed to current annual production, we see that Gold Fields has much more reserves in terms of their reserve life. Or does it mean that their production compared to reserves is relatively smaller? Both statements are correct. Those are different sides of the same coin, and I'm going to use a discount rate of 5%. If you would use a different discount rate, let me know down in the comments below. Perhaps a higher discount rate to reflect higher risks is appropriate here. So with all of this data in mind, plugging into our conservative valuation, where again, remember, we plug in the gold price of only $1,600, and we only take into account proven and probable reserves in the ground. In that case, the discounted value per share is just under $5.50 for AngloGold Ashanti and just over $6.30 for Gold Fields. That's pretty conservative. That's perhaps below half of the ongoing market price. Usually market price is much closer to our balanced valuation, which in this case plugs in the gold price of $1,900 and still looks at only proven and probable reserves in the ground. In that case, the balanced valuation for AngloGold Ashanti is slightly over $19.60, and for Goldfields, that's at $13.06. Current market price is slightly below these numbers, but if you go closer to the beginning of this year, you would see that market price was around these prices presented here. That shows general alignment of my model with what's happening on the markets, except for those day-to-day to week-to-week fluctuations. And most excitingly, looking at the optimistic valuation, where we plug in the gold price of $2,200, and we only value the proven and probable reserves with only half of measured and indicated resources, never mind any of the inferred resources or further exploration success. In that case, the valuation for AngloGold Ashanti is well over $52. That's over double the balanced valuation. As I mentioned, the leverage play in AngloGold Ashanti is larger than that in Goldfields, where we see the optimistic valuation doesn't reach a double of the balanced valuation. For GFI, the optimistic valuation is slightly over $24.50. So to emphasize the leverage play versus gold price, as gold price increases from $1,600 all the way up to $2,200, we see that the valuation for AngloGold Ashanti increases by a larger percentage. Talking about AngloGold Ashanti, they've recently entered into a very interesting, perhaps promising earning agreement with one of these junior miners, which I'm going to discuss in detail at myfinanceteacher.org in the next several days. So for somewhat fundamental valuation of these junior miners that might provide that additional torque to your portfolio once gold price finally breaks consistently to new all-time highs, remember to join us at myfinanceteacher.org. Have a fantastic Friday. Bye-bye.